President Obama, who was described in the Financial Times this week as full-time president and part-time auto analyst, predicts that General Motors will ultimately be a strong company. Meanwhile, we learned this week that U.S. home sales are on the rise, and a survey of American economists shows that more than 90% of them think the recession will end this year. This all sounds like good news, doesn't it? So I can't wait to hear what Neil Ferguson has to say about it. Neil is, of course, a frequent guest here on GPS, has described himself as a moderate doomster. He is also an esteemed Harvard historian, as well as the writer of 9 books, the latest of which is the New York Times bestseller, The Ascent of Money. And Joshua Cooper Ramo is another New York Times best-selling author. His fascinating book, The Age of the Unthinkable, has one of those wonderfully self-explanatory titles, I think. Joshua is managing director of that international consulting firm that is run by Henry Kissinger Associates. Neil, so that was the good news I pointed out, but there was also some bad news that's a little more complicated to explain, the Treasury auctions. Well, explain what you think is going on.
One consequence of this crisis has been an enormous explosion in government borrowing, and the US federal deficit, that's the difference between what the government spends and what it raises in taxation, is going to be equivalent to around $1.8 or $1.9 trillion this year alone, which is equivalent to nearly 13% of gross domestic product. There hasn't been a deficit that large since World War II. It's actually comparable in magnitude to the 1942 deficit, but I'm not aware of any world wars currently going on. So my view is that this is an excessively large deficit. It can't all be attributed to stimulus, and there is a problem. And the problem is that the bond market, which is already reeling from a global financial crisis, is staring at an oncoming tidal wave of new issuance, and it's taking fright. So the price of 10-year treasuries, that's the standard benchmark government bond, took quite a tumble in the past week. In fact, it's taken a pretty steady tumble since December of last year. So the interest rates, long-term interest rates, as a result, have gone up by, well, it's actually quite a lot. It's 100+ basis points. You could actually say that long-term rates have risen by about 75%, by 3/4, in the space of just 5 months. And that poses a problem, since part of the project in the mind of the Federal Reserve Chairman Ben Bernanke is to keep interest rates down.
So is it fair to say that this bad news, the fact that we can't sell our debt as cheaply as we thought, overshadows all the good news that seems to be coming?
Well, I mean, I'm not sure that the fate of General Motors can be regarded as good news. But then I'm from Britain, where we tried to take over the automobile industry in the 1970s, and that didn't end too well. Right. But the green shoots that are out there seem to me like tiny little weeds in the garden. And what's coming, it seems to me, in terms of the fiscal crisis of the United States, is a far bigger and far worse story. I think all talk of recovery or of end of the recession is wishful non-thinking.
Josh, this seems like, in a strange way, an episode in your book, because we have a big crisis. We try to solve it with the tools that we think we know, which are Keynesian tools. Maybe it's solving it, maybe it's solving it and producing a whole new crisis.
Problems, right, because we're talking about, for instance, the situation in the U.S. debt market. That's one thing. But imagine if you're borrowing from the U.S., or the U.S. is borrowing from you, and you're paying them, 8% a year interest. If you're Hungary or you're some other country, you're going to have to pay even more to get people to take your debt. And so what you worry about is a fiscal crisis in the U.S., which then spreads around the world. And we had a lot of discussion earlier this year about the risk of a European sovereign default. We haven't heard much about it recently, but the continuing failure of these auctions, and it's worth noting this is the third one of these to fail in the last 4 months. They fail by the means you have to go and reprice them.
You have to charge higher interest rates than you thought you would.
Is an indication of exactly what you're saying, which is these are network effects here. We're all interconnected. The reason this crisis is so terrifying is the speed at which it spread from being a subprime crisis to a financial crisis. We're now injecting the entire system with an amount of demand for debt that's never been seen in human history before. It's impossible that that's not going to trigger ripple effects.
So why do 90% of economists think things are getting better?
Well, of course, they're economists, and they're trapped in Econ 101 land, like that New York Times columnist Paul Krugman, who assured me only a month ago that there would be no upward pressure on interest rates because there was a massive excess of savings in the world economy. The Keynesian model actually didn't work terribly well, even when it was popular, and ultimately it got us into the mess of the 1970s, a mess which, of course, produced double-digit inflation, and then required the Fed to produce double-digit interest rates to bring inflation under control. So I think one should take what the economists say with a very large pinch of salt these days. After all, very few of them anticipated this financial crisis because their wonderful models didn't predict that either.
Why did nobody anticipate this? I mean, what does that tell us going forward?
Well, this is the classic symbol of a revolutionary era. I mean, when I call it the age of the unthinkable, it's really basically another way of saying we're living in a revolutionary era. The first thing that happens in a revolutionary era is the great figures of the old era get discredited. So Greenspan last October, sitting in front of Congress saying, guess what, I was wrong, 40 years of experience was worthless, is a marker of a revolutionary time. What then happens is people get elevated from positions of great obscurity into positions of great power, whether they're caves in Pakistan or the Illinois State Senate. And what's going to happen now is a regeneration of new economic ideas, and that's what you have to hope for. But the old models, just like the old models of war fighting don't work to fight the wars that we face today, these old models of trying to battle a financial crisis not only don't work, they make the situation worse.
So what the hell do we do?
Well, I think one thing that could be done, and done very quickly, is for the president to give a speech to the American people and indeed to the world explaining how the administration proposes to achieve some kind of medium-term stabilization of American public finance. Because you can't blame all of this on the crisis. There's actually a structural deficit that's nothing to do with the economic cycle, equivalent to around 5% of GDP. If you look at the administration's budget
which explain that, that's
to say,
Medicare,
leave aside the fact that we're in a crisis at the moment, there is still a fundamental imbalance between the federal government's expenditure, even in a normal year, and its revenue. The tax base is too narrow or the expenditure is too great. And off balance sheet, you have these enormous liabilities of the Medicare system and the Social Security system that are really driving the United States towards being, frankly, a Latin American economy in financial terms. And that's something that needs to be addressed soon. The administration doesn't have that long a honeymoon period. It's got very little time in which it can introduce the American public to some harsh realities, particularly about entitlements and their future cost. And I think if a signal could be sent really soon to the effect that the administration is serious about fiscal stabilization and isn't planning on borrowing another $10 trillion between now and the end of the decade, then just conceivably markets might be reassured. It's not as if the US is Argentina. I mean, there still are fundamentals here which are really healthy. It's still a dynamic entrepreneurial economy which produces technological innovation, all the rest of it. But at the moment, its tax system and its expenditure system are really wildly out of whack, and they need to do something soon. Or credibility, and that means the credibility of the dollar as an international reserve currency, could ebb away really quickly.